Right, let's jump straight into it. Welcome to this explainer, where we are going to systematically break down the core South African Income Tax Act provisions you absolutely need to master for your SAICA board exams. Look, if you're a BAccSc or CTA student, you already know that the General Deduction Formula is basically the beating heart of tax. But what happens before a trade officially kicks off? Or what happens when you pay for expenses way in advance? And maybe most importantly, what do you do when the Act specifically steps in and says, nope, absolutely no deduction for that? Well, today we're navigating these exact scenarios. We're going to hit SAICA level depth so you have the technical precision you need to completely dominate your exams.
Okay, so here's our logical exam roadmap for today. We'll start with pre-trade and prepaid expenditure, move into the prohibited deductions, tackle double deductions and VAT, run through a fully integrated worked example, lock in your exam technique, and finally, wrap up with a revision summary checklist.
Let's get right into Section 1, Pre-Trade and Prepaid Expenditure.
So remember that the General Deduction Formula, Section 11A, actually requires a taxpayer to be carrying on a trade. That means pre-trade expenditure generally isn't deductible under 11A because, well, you haven't started trading yet. To claim those startup costs in the year trade finally commences, you have to rigorously test three specific Section 11A requirements. First up, the expense must actually be incurred before commencement and in preparation of carrying on that trade. Second, you have to pretend the trade was already running. If it was, would the expense have qualified under Section 11, 11D, or 24J? And third, it obviously can't have been claimed before. But listen, here is the massive trap examiners love to set for you. Capital expenditure is explicitly excluded. For example, if your client drops a ton of money renovating a building before starting a rental trade, those renovations are capital in nature. No way do they qualify under Section 11A.
This brings us to a brilliantly simple illustration of the ring fencing rule. Section 11A2 strictly limits your pre-trade deduction to the income generated by that specific trade in the current year. Any excess is locked or ring-fenced to that trade. Let's say you spent R60,000 on municipal rates getting a new rental property ready, but you only earned R50,000 in rental income during that first year of assessment. So you've got a R10,000 excess, right? Now imagine you also earn R10,000 in royalty income from a totally different unrelated trade. Can you just slide that rental excess over to offset your royalty income? Absolutely not. That R10,000 excess is carried forward to the next year, securely ring-fenced to be set off against future rental income only.
Okay, so that was money spent too early. Now let's shift gears to expenses paid too far in advance. Section 23H exists to limit and defer the deduction of prepaid expenditure. In an exam setting, you need to follow this exact step-by-step logic gate. Step 1. Verify the expense actually qualifies for a deduction under Section 11A, C, D, W, or 11A. And pay attention here, this expressly excludes trading stock. Step 2. Check if the goods, services, or benefits extend beyond the current year of assessment. If they do, the deduction must be apportioned. Unless, and this is a really big unless, you are saved by Step 3, testing the provisos.
The absolute most crucial points here is the application order of these four provisos. If even one of these applies, the full amount is deductible immediately. You totally bypass the 23H limitation. When you're sitting in that exam, always test DD, AA, and CC individually first. Ask yourself, is it an unconditional legislative liability? Are all the benefits supplied within 6 months after year-end? Only after you've pulled out those specific exceptions do you take all the remaining prepaid amounts across the taxpayer's entire affairs and test them against the R100,000 threshold of Proviso BB. If that remaining total exceeds R100,000, 23H defers the deduction.
You really can't talk about Section 23H without looking at the case law. The Telkom case is the perfect example of how courts dig into the true substance of a prepaid benefit when a contract term is involved. In this case, Telkom paid upfront incentive bonuses to an agent for connecting subscribers on 24-month contracts. Telkom tried to argue that the benefit was received immediately upon connection, but the court disagreed. They said no, the expense actually resulted in two benefits, concluding the contract and the ongoing monthly subscription fees. Because Telkom was getting benefits over a fixed 24-month period, well beyond the year the commission was incurred, Section 23H kicked in, and they had to spread that deduction over the entire subscription period.
All right, moving on to Section 2, the Prohibited Deductions.
When you're trying to memorize Section 23, chunking these prohibitions into categories is a lifesaver. Let's look at personal expenses first.
Watch out for 23A and B, absolutely no private home expenses unless it's a strictly qualifying home office. And under 23M, salaried employees are severely restricted in what they can claim. On the financial side, 23E forbids provisions, 23H blocks notional interest, and 23R strikes down income protection premiums. Oh, and don't forget 23C blocks expenses recoverable under insurance. 23I stops you from double deducting retirement fund contributions, and 23Q blocks expenditure-producing foreign dividends. Finally, looking at trade limitations, 23O forbids unlawful bribes and fines, and 23K places strict limits on labor brokers. It's a lot, I know, but spotting these red flags is key to scoring high.
Now, case law beautifully clarifies Section 23G, which is the non-trade expenditure prohibition. Sometimes an expense seems totally unrelated to day-to-day operations, but if its underlying purpose protects the trade or enables income earning, it actually escapes the prohibition. Take Warner Lambert, for instance. Their social responsibility expenditure was deemed deductible because if they hadn't incurred it, they would have lost their subsidiary status. The expense literally protected their trade and earnings. Then you have the Scribante case. The court ruled that interest incurred on a loan used to pay a dividend is actually deductible, provided the company had the original funds but actively chose to keep them employed in the business to earn income. Because the true purpose of borrowing was to enable the earning of income, it satisfied the trade requirement.
Let's dive into Section 3, Double Deductions and VAT.
Section 23B1 makes it clear that no amount can reduce taxable income more than once. But it's Section 23B3 that is absolute magic for your exam technique. Specific deductions always take precedence over the General Deduction Formula. If a specific section applies to an expense, you cannot claim a general deduction under 11A. Full stop. And this holds true even if the specific deduction limits the amount or if it defers it to a future year of assessment. The specific rule is always going to crush the general rule. Also, keep a really sharp eye out for employee insurance policies in your exam scenarios. Under Section 23B5, if an employer pays premiums for an employee's life or disability policy, it is broadly prohibited. The only way it sneaks through as deductible is if the policy relates to an event arising solely from and in the course of employment. So think of specialized travel insurance for a specific business trip or workplace hazard disability cover, but general life cover, not deductible.
Now for Section 23C. This binary rule is such an easy place to either lose or gain marks. Before you even touch your calculator, always verify the taxpayer's VAT vendor status. For example, if your client buys trading stock for R$115,000 including VAT, and they are a registered vendor, they'll claim the input VAT. Therefore, for income tax purposes, you must strip the VAT out and only claim a deduction on the R$100,000 base cost. Conversely, if they're a non-vendor, they can't claim input VAT, meaning the full R$115,000 is included in the deduction.
Okay, theory is great, but let's see this in action. Section 4, Integrated Worked Example.
Here is our scenario. ABC Limited is a non-vendor with a December year-end. We've got a nice mix of prepayments, staff costs, and potential prohibitions here. They signed a 2-year lease for a branch starting October 1st, and they pay a R$120,000 upfront annual insurance premium on the 1st of November. Later, in December, they pay a R$50,000 traffic fine and R$30,000 in staff performance bonuses. I highly recommend pausing the explainer right here if you want to test yourself first and try calculating the deductions on your own.
All right, let's break down the model solution and look at how the marks are allocated. The traffic fine, that's an easy 1 mark. It's R0 because it's explicitly prohibited under Section 23O as a penalty for an unlawful activity. Next, the R$30,000 staff bonus is fully deductible under 11A since encouraging staff effort is firmly in the production of income. Now let's look at the insurance. Because ABC is a non-vendor, we don't strip out any VAT. Under 11A, the full premium theoretically qualifies. But wait. Section 23H triggers. The current year portion, just November and December, is 2 months, which gives us an R$20,000 deduction. The remaining 10 months is prepaid. Does it pass the provisos? Well, it extends more than 6 months after year-end, so Proviso A fails. For Proviso BB, our prepaid amount is exactly R$100,000, so technically it does not exceed the limit. However, if we assume the client had any other prepayments across their fares that push their total over this threshold, the R$100,000 fails Proviso BB and gets deferred to the next year.
Section 5. Master the exam technique. Let's make sure you don't drop any easy marks.
You really need to memorize this sequence. First, immediately scan the dates to confirm if trade has actually commenced. If it hasn't, 11A is out of the window and 11A is your go-to. Second,
Find the VAT vendor status in the scenario intro before you even think about picking up your calculator. Third, remember that Section 23H is a limitation on Section 11. You can never apply 23H to an expense that didn't even qualify for a deduction in the first place. Fourth, always process the 23H provisos in the exact sequence: DD, AA, CC, and then aggregate everything for BB. And finally, prove the positive test of 11A before you jump into the negative test of the Section 23 prohibitions. Follow these steps systematically, and you'll naturally construct answers that examiners just love to mark.
Finally, Section 6, our revision summary checklist. Okay, let's do a rapid-fire recap. Section 11A allows startup costs, but capital is completely excluded and excess is ring-fenced to the same trade. Section 23H defers prepayments extending beyond the year unless you are saved by a specific proviso. Section 23 is your strict negative test blocking private, non-trade, and unlawful costs. Section 23B reminds us that specific deductions will always override the general formula. And Section 23C dictates your VAT inclusions or exclusions based on vendor status. So the ultimate question is, do you feel confident applying these structural rules to a complex, multi-layered scenario? And are you truly ready to spot the hidden Section 23 prohibitions lurking in your next exam paper? Master these concepts and you've mastered the deduction formula. Keep practicing and good luck.